all, welcome to ICPA's CPE Business Conference on China Practice in collaboration with RSM Chiu Lim and Citibank today. We are delighted to have with us a panel of distinguished speakers to speak on the latest developments in China accounting, auditing, and tax. Each speaker will make a presentation in their respective areas of expertise, and we will have a panelist discussion at the end of the presentations. Before we begin, this is a gentle reminder for all of you to turn off your mobile devices. Without further ado, we will begin with our first speaker of the day to give an overview of the latest developments in China tax regimes. He is Mr. Charles Gong, tax partner of RSM China, Certified Public Accountants, who has over 12 years of tax experience in both the Big Four international accounting firms as well as state administration of taxation of the PRC. Mr. Gong also sets the tax papers for the CPA examinations in China. Let us now invite Mr. Charles Gong to make his presentation.
Good afternoon, everyone. My name is Charles Gong. I'm from RSM China. In today's presentation, I'd like to share with you the latest and significant development of Chinese tax regimes and some key issues for a foreign investor who have or will have business in China. I hope this presentation can provide a full picture of China tax regime and equip you with high-level knowledge and therefore benefit your existing or potential investment in China. My presentation will include the four topics: overview of latest tax departments, key issues for foreign investors, tax incentives available, and managing tax risks. In part one, I'm going to give a brief introduction of China tax regime at first. Then let us have an overview of the latest and significant development of China tax. In the end, I'm going to share our outlook of the upcoming tax reforms in the year come. China tax regimes is weighted in both direct tax and indirect tax. Direct tax, including corporate income tax, individual income tax, accounts for less than 30% of the total tax revenue. The indirect taxes account for 60% around. Currently, there are 20 kinds of taxes in China. The major taxes may include the following 8 kinds: corporate income tax, individual income tax, value-added tax, business tax, consumption tax, custom duty, resource tax, and real estate tax. Their rates range from 1.2% to as high as 45%. Since the effective of the new CIT regime from January 1st, 2008, the popular holiday for foreign investment, which is well known as a 2-year exemption and a 3-year half for manufacturing company, has been cancelled. Incentives have been changed from region-focused to industry-focused, and dividend extracted from China has been liable for withholding tax in China. Also, a new transfer pricing regime is introduced in the new regime, and there are many clauses in the CIT law and its regulations which are aiming to strengthen anti-tax avoidance and the tax administration for non-resident enterprise. For value-added tax, the global financial crisis spurred the Chinese government to enforce the CVT, consumption type VAT, nationwide from January 1st, 2009 to encourage the fixed assets investments. Accordingly, to prevent the sharp downturn of exportation, China had raised its export VAT refund rates intensively for 7 times continuously from August 2008 to June 2009. The raised involved machineries and electronic products, textile, clothes, toys, steel products, and so on. Recently, in order to adjust the economic structure and restrict the emission of carbon, China canceled the VAT refund for 406 kinds of goods related to high energy consumption, high pollution, and resource-intensive industries. R&D centers, both foreign invested or domestic invested, may not be VAT taxpayer because it has no sales of goods. To attract MNC to set up an R&D center in China and encourage the development of R&D center, China grants qualified R&D center with VAT refund for purchase of equipment from domestic vendors. From January 1st, 2009, offshore services provided to or by Chinese company or individual shall be subject to business tax. It means that a foreign company's offshore service to a Chinese client would be subject to Chinese business tax. In practice, the business tax will be withheld at a source by Chinese fee payer for remittance purposes. The remitting bank will require the fee payer to present a tax certificate to give a green light. After the enforcement of the new business tax regime, some BT incentives were granted to encourage certain industries. For example, the offshore outsourcing services. BT will be exempt for the Chinese companies' offshore outsourcing income, including information technology outsourcing, business process outsourcing, and knowledge process outsourcing, if the Chinese company is located in 21 designated cities such as Beijing, Shanghai, Tianjin, etc. Generally, BT basis includes full considerations received plus the other charges such as on-behalf payments. In Shanghai and Zhejiang, the local tax bureau begin to allow the taxpayer to pay business tax on the net revenue for some items. It is also expected that